Okay. Okay. Well, hi, everybody. I'm so glad that you can make it here tonight. We do really have a treat in store for you. But first, I wanted to introduce my staff. For those of you who don't know, maybe you all know, but Darren Costa, wave Darren. He is my right-hand guy, and he's
Hey, everybody.
my operations manager, and really nothing happens if Darren's not involved in it. He really keeps the whole thing together. And for those of you who haven't met Alex, my marketing person, she's responsible for the end of the year report that you should have all received, and also the fun and refreshments deliveries on the Tuesday and yesterday. And then you've got Alexandra, who is my media maven.
Alexandra is our social media representative.
And Alexandra assists me in the day-to-day marketing, as well as runs our social media and digital marketing efforts. She does a wonderful job.
And I think Kari's got an introduction for Matthew, but I have no idea what that introduction is.
So sorry, you guys. You know, I want to thank Wendy Lewis and Judy Myman and Alex for doing the fun and refreshments things. And you might be wondering why I didn't deliver it. It's because I have COVID. So my apologies. I have been feeling much better, but obviously timing is everything. And I've been fine all day. And now, of course, we're on here. So I'm very thankful for the vaccinations and booster shots, because without it, I think we'd be in big trouble. So thanks to Alex for having the foresight to have this on Zoom. And I hope we can all be together next year. So the past year has been a whirlwind and a frenzy in the market. And, you know, we've had my daughter's wedding. So Oliver went to college, and at the same time, we helped a lot of people. And the reason why I tell you this is because we helped 30 first-time home buyers attain their dream home of home ownership in a little over a year, which was far more than people who already had homes, which I think is significant for the marketplace right now. And, you know, there's options for everybody. So let your friends and family know that now is the time, because prices are rising, and Matthew's going to speak more to what's happening out there in the marketplace, but it really is a good time to buy right now. So whether they're first-time home buyers or have a home to sell, I'd love to help them. But now, without further ado, because you've waited quite a bit, we have Windermere's chief economist, Matthew Gardner, here with us this evening. And Matthew is a well-respected local and national economist who's been right on the money for all of the years that I've been a real estate broker and advisor. And so as chief economist for Windermere Real Estate, Matthew is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and national level. Matthew has over 28 years of professional experience both in the US and the UK. And in addition to his day-to-day responsibilities, he also sits on the Washington State Governor's Council of Economic Advisors. He chairs the Board of Trustees at the Washington Center for Real Estate Research at the University of Washington. And he's an advisory board member at the Runstad Center for Real Estate Studies at the University of Washington, where he also lectures in real estate economics. So he is one of a select number of economists who provide their housing market forecast to Reuters for their home price forecast survey, and also participates in Zillow's home price expectation survey. So I'm incredibly honored to have Matthew here, and thank you, Matthew, for referring clients to me this year, because that was really a huge honor. And I'm happy to have him here to speak about the local and global economy in 22 and beyond. And if you guys want to put your questions in the chat box, we'll have an opportunity to have Matthew answer them after the presentation. So here he is, Matthew Gardner, take it away.
Thank you, Kari. I'm sorry you're not feeling good. So hopefully your throat will get a little bit better. Hello, everyone. It's we're still doing this Zoom thing 2 years later. Who'd have thought it? I can swear that the if I ruled the world, I would come out. The T-shirt for 2021 would be "You're on mute." But anyway, so I digress. As Kari said very kindly, I'm going to touch on the economy, but most importantly on the housing market. I'm going to focus on the Tri-County area, as she asked me to. So, but if you have anything very specific to a certain sub-market, absolutely, I'm in no hurry. We can get to the Q&A afterwards, and I'll be happy to try and address those questions for you. So let's get going. Hopefully you can see a screen. Please tell me you can. Yay, all right. All right, so starting off. And again, I'm not getting to the national economy, although just before I get into the regional part, nationally speaking, there's a couple of things going on. One, GDP numbers came out for Q4, blew expectations out close to 7%. My forecast was actually modestly south of 6%. So we are going to continue to see expansion, but the problem is the bug and all its variants. And what I fear is there's still a lot of letters in the Greek alphabet we haven't got to yet. So I'm hopeful that, I really think that in the US and certainly here in Washington, we're going to go a very similar way to that we saw back in the UK. And we saw a massive bump in new infections, a significant increase in December. It's been dropping by 20% per week over the course of the last couple of weeks. And I think we've reached that apex here as well. So nationally, I think we're going to start seeing a significant decline in new infection rates, starting likely at the end of the month. Now, of course, can there be other iterations? Yes. BA 2.1 I'm watching right now, another variation of the Omicron variant. I happen to live next to an epidemiologist at the Gates Foundation. I hear a lot, but it is getting better. We are getting through it, but it is holding the economy back to a certain degree, mainly on the job front. But I'll talk about that more in a second. But the bottom line is that we're going to continue to see the economy expand across the country this year. We will likely get back to full employment. I say full employment, a recovery of all the jobs lost due to COVID-19 across the US by the end of this year. So we are getting better, not worse. That's a good thing. And with that said, let's talk about our local economy. So on the employment side, this is just all the metros within Washington state and the jobs lost because of COVID and the jobs recovered. Now, Seattle, by far the biggest economy, therefore suffered the most. But we're also seeing some of the smaller metro areas already having recovered fully. Olympia has seen a full recovery. Longview has. Tacoma, Spokane, Kennewick, Wenatchee, they're getting close. And so we are certainly, I think, the argument would be a glass half full. There is a light at the end of the tunnel. And looking here, and again, most of this stuff is going to be about King, Snohomish, and Pierce County. So the Seattle Metro is King and Snohomish County. A bit more than 10,000 jobs were added in December, very decent number. So we are getting a little bit better in that respect. A good number also down in Tacoma. But you look at numbers and it kind of somewhat meaningless. But other than the fact that you can see April of 2020 here in the Seattle Metro, in 1 month, we lost over 190,000 jobs, disappeared in 1 month. Far less than that, obviously, down in Tacoma, but the recovery is palpable. Now, I'm an economist, so what do economists like to do? We like to create indexes, kind of what we do. And so what I did is I created an index on employment to compare what's happening now with jobs with what happened through the Great Recession, through the financial burnout that we had in 2008. And so basically, it took us basically more than 5 years, 5.5 years to fully recover from the Great Recession. But we're doing a lot better. So we saw a far sharper drop because we turned the economic lights off in March of 2020. But the improvement is certainly there. And down in Tacoma, well, they are getting very, very close to that full recovery, and certainly a lot quicker than the more than 7 years it took to recover all the jobs lost back in 2008. But what's been fascinating is that the COVID-19, the pandemic, it didn't hit everyone equally. Now, we might have got infected equally, but from a business perspective, very much that was not the case. And so if you look at the Seattle Metro, who got hit worse? Well, you can see here, bars, restaurants, hotels, lost over 78,000 jobs, but we're back by almost 50,000. But more importantly, look further down. Retail, full recovery. Professional business services, full recovery. Financial activities. And then look at information. Thank you, Amazon. They shed 500 jobs, basically front of house workers. They've added over 15,500 since that point in time. Yes, we were all buying toilet paper on Amazon. And it has been, the technology sector has been, again, another shining light through the pandemic. But more importantly, it's the fact that this pandemic, as far as real estate's concerned, hit renters far more significantly than it did homeowners. They were the more face-to-face industries that got hit the worst. Leisure, hospitality, education, retail. But as far as white-collar sectors are concerned, well, quite frankly, I don't know anyone of my friends that lost their jobs. Yes, they're all working from home, but they were all still working. That's part of the reason why we've seen such a robust housing market on the ownership side over the course of the last couple of years. And down in Tacoma, they've actually got all those leisure and hospitality jobs back and some. So a more robust recovery, but again, a smaller market. Transportation, warehousing, utilities done very, very well. Business services, again, a full recovery. So the Tacoma market is feeling a little bit full of itself right now. And certainly downtown Tacoma has expectations, as it tends to do, that we are going to see a whole bunch of companies start moving that direction. Can somebody mute that person, please? We're going to see more companies look to move further south in terms of not equal compared to Seattle, but it's interesting to see the fact, well, basically that the COVID-19 impacted different business sectors in very different ways. Unemployment, again, across the state, horrible. Mount Vernon, Skagit County, almost 20% unemployment at its peak. But those are the peak numbers, latest numbers. We haven't got December yet. They come out next week, but still very robust. Yakima's hurting still a bit, mainly because of agriculture. But in general, we are in a lot better shape than we were. And in the metro areas and central Puget Sound, we're knocking around 4.4 in Seattle, 4.2 in Tacoma. Pretty impressive compared to where we were. Now, I also want to touch on one other thing, because I mentioned Amazon earlier on. I think it's going to be important, and here's why. Well, this looks at the space, office space that Amazon consumes and has done over time. Big move started really in 2010 when they moved off Beacon Hill, came downtown. But what I want you to look at is the future. Why is that important? Well, look where all the growth is going. It's not in Seattle. We have 53,000 workers at Amazon working in Seattle, either remotely or in person. But all the growth going forward is going to be in Bellevue, or at least on the east side. And that is something that's yet again another shot across the bows of City Hall here in terms of the business environment. And when you think about the east side and Bellevue, this just gives you an idea, not just the space that Amazon has and they own and they lease, but because of that, other industries and other developers going to town in Bellevue. Really quite remarkable. Now, I certainly do not expect that Amazon's going to leave Seattle. I just don't see it. However, their growth is likely not to come in their main center as it was back in the day. It is going to look elsewhere. It is going to look to the east side, not just Bellevue. Think Redmond, which is actually going to be the home of their low Earth orbit satellite group. They bought the old JCPenney site to demolish and rebuild, but it's going to be on the east side. So they're not leaving Seattle. Don't expect that, but a lot of the growth is going to come there. And part of the reason why, think 2024. If your timing is right and you have a meeting, let's say if you're in Seattle at Amazon, you have a meeting in Bellevue, oh, if you get it right, you'll be there in 12 minutes on light rail. So I think we're going to see the east side really even more come into its own as an autonomous business center that's not subordinated to Seattle. On a forecast standpoint, this is what to look at. We added over 90,000 jobs, recovered, shall we say, in 2021. My forecast for this year, a bit more, about roughly 55,000 new jobs this year. Good number. Now, it's certainly below the recovery level we saw in 2021, but still well above the long-term average, which is roughly 45,000 jobs per year. So still a solid amount of growth. And down in Tacoma, about close to 10,000 jobs will be added this year, coming in slightly below the number that we saw in 2021. But the South End market certainly is doing very well. So regionally speaking, what do I think? Uncertainty. Why uncertainty? Think bugs. I am an economist, not an epidemiologist, but I know more about this bug and protein spikes and Lord knows what else than I would ever like to know. But the trouble with this is that it creates uncertainty, and uncertainty for an economist is very hard, as it is for businesses. But as I said earlier on, for the few people that were here 20 or so minutes ago, and that is fact, I really think we are going to see a drop down in new infection rates. We are going to get back to a new normal over time. It is going to get better. Unlikely it's going to get worse, but it is still uncertain. So my forecast, yes, I think I feel very comfortable with them, but there could be some movements depending on if we see another variant come along that maybe is worse than Omicron or worse than BA2, which is yet another variant that we're seeing on the horizon. So all things being equal, however, I believe we'll be back to full employment certainly by the end of this year, and we will move forward. Local legislative initiatives, well, that's actually a sideways slap at the city of Seattle and our elected officials there. They are, shall we say, not that business friendly. And that's a concern. And it's a concern for one reason, as far as I can see. And that is a lot of companies, because of COVID, are quite likely to move to what I call a hub and spoke model. Now, the hub and spoke model means that you'll keep your mothership, your central location, but as you choose to grow, you may well not grow in that spot, in that location. You will send out spokes into other markets. Ergo, that's what may well happen down in Tacoma, but not just Tacoma. It wouldn't surprise me to see significant expansion in markets such as Spokane, Boise, Idaho, Las Vegas, Nevada, as well as Salt Lake City, Utah. So a lot of companies are looking around saying, where's it best to be? And there's a lot of decisions they have to make about that. The biggest thing is there a talented workforce I can hire? And here in Seattle, we are wicked smart. In fact, we have the highest propensity for our residents to have a bachelor's degree or higher than any other large city in America. So we're smart. But the trouble is housing and housing cost. So the CFO is not worried about how smart people are. He's worried about how much you have to pay them. And at what point are they going to say, I've got to pay people how much not to live in a shoebox? We have to be very, very careful with housing affordability and the ability to create housing that people can afford to buy. And that is probably the biggest thing that concerns me. I'll talk more about that a bit later on. I'm hopeful, therefore, well, although I guess what I'm really trying to say is that Mayor Harrell's got a very big, not problem, task ahead of him to try and get council back to a more centrist road. And here, and I live in downtown Seattle, certainly there's a humanitarian crisis. I understand it. But we need to be thought about how to address the needs of the business community as well as everyone else. We are diverse. Now, we can think that there will be remote workers. That may not be good for some of our urban markets or even King County. But I would caution you that, yes, that is true. However, what people are actually ignoring is the biotechnology sector. The biotech sector, Seattle last year was the fastest growing biotech hub in the country in terms of number of employees. Now, these are people that can't work from home. They have to be in their labs. So where we might find some tech people moving out, quite likely we'll see biotech people moving in. So all is certainly not lost in that respect. Yeah, there are headwinds, but Full recovery, absolutely, by year's end is what I'm expecting. All right, so that's the regional economy. Everything you wanted to talk about or hear about is housing. Home prices. I hear day in, day out, we have 6,330 brokers at Windermere. And probably the question I get asked more than any other across the entire network, across all 10 states is, what is going on with home prices? And what has been driving that? And it's really rather simple. Insufficient supply. We are not building enough houses. I'll talk more about that later on. Secondly, mortgage rates. Yes, they have moved up significantly in the last couple of weeks, but from an historic perspective, remarkably, remarkably cheap. But also people that think, yeah, work from home, they're rethinking their lives. Where are they going to go? And where are they going to live? Is it going to allow them the opportunity to move further out? Maybe if they're renters, to find somewhere they can afford to buy. I believe it will not be work from home is not black and white. We're not all leaving to disappear off to the wild blue yonder. We will have 1 foot in an office, 1 foot out, 2 or 3 days a week in or 2 or 3 days a week at home. And that means that we can move further out, but we're not disappearing off into Ohio or something. So this is what's been going on. But most importantly is this. The price is rising not because of speculation, not because of these insane mortgage products that maybe one or two of you may remember from back in the early 2000s, the 228s, 327s, option arms. That was a fun one. Choose your mortgage payment. What could possibly go wrong? But it has not been that. So it is a very different environment we're in today than we were there. But because we've seen such robust price growth, for the reasons I show here, a lot of people are saying, oh, it's a bubble again. I'm afraid, I'm sorry, it is not. Now, we talk about insufficient supply. Here I'm just going to look particularly at King County. So we permitted about 17,500 units back in 2005. Dropped down significantly, but look what it's been like for the last 7 or 8 years. At the same time, that right axis, now you saw a massive drop in 2021. Thank you, COVID. But we're creating far more people living here than we are creating housing permits. So if we're not building enough, what does that do for the ownership housing market? Well, it pushes prices up. Go back to the day. Remember Econ 501, right? Limit supply, have net new demand about anything. What happens to prices? They go up. So are we in a balanced market? No, absolutely we're not. We haven't been building enough. We've still been creating households, still been a lot of demand for ownership housing the last few years, and especially because mortgage rates have been dropping precipitously. And that's caused a problem. And the problem is more demand than supply. If you look at months of inventory, and this is the Tri-County area, a balanced market should be probably somewhere between 4 and 6 months. Actually, I believe for the Settle Metro, it's probably closer to 4 to 5. That's balanced. We haven't seen balance. This is both existing and new homes. We popped up briefly on new homes in 2018, but in general, not a balanced market at all. I mentioned mortgage rates because that is something that's very important. Now, we've seen a spike. This is the average weekly rate on a 30-year conventional mortgage. You can see here that massive spike we've seen in the last couple of weeks. But guys, let's get some perspective here. I only took it back to 2018. We almost hit 5%. Now, in general, people are saying, yes, it's still low, but they are getting concerned about the jump. Now, the increase we've seen, blame the Federal Reserve, blame Jerome Powell, because in essence, same reason why the stock market's been doing its thing. They're winding down their purchases of mortgage-backed securities, winding down their purchases of 10-year bonds. 10-year bonds, by the way, are what sets mortgage rates. So the yield on 10-year paper plus a risk premium equals mortgage rates. And so given that, we've seen a significant spike in rates. But we broke above 3.5% last week. I think it's probably going to hang around. I don't expect much in the way of an increase anytime soon. And when we look forward, well, this is my forecast through the balance of the year. I still do not see mortgage rates starting with a 4 handle until 2023. Could I be wrong? Of course I could. But I actually have an occasional happy hour with some friends of mine. And they're the chief economists for Fannie Mae, Freddie Mac, National Association of Realtors, Wells Fargo, and the Mortgage Bankers Association. Dry group, but a couple of cocktails, they can be fun. But all of them, all of us rather, we all agree that yes, rates will rise, but no one, mortgage bankers say we might break 4% by Q4, but everyone else, and they are certainly very smart people, we're all in essence in the same camp, that rates will rise, they'll stair step higher. But what's that going to do? Is it going to cause prices and demand to drop? Not at 4%. We need to get closer to 5% before we see that. And in fact, we saw that locally, and we saw it across the country back in 2018, when we almost hit that 5% barrier. For no. Will it mean some selling people have to pay a little bit more on their mortgage? Yeah. But it's not enough to cause any kind of systemic adjustment to home price appreciation. But they are going to step up, and that will act as a headwind to home price growth going forward. Now, I can look at this, and many of you will as well, and say, wow, that's still cheap. Because it is. The long-term average since the 30-year fix was created in, 1971, is 7.5%. Though most of us here will think that's cheap. Who doesn't think it's cheap? Millennials. They're like, this is daylight robbery. 4% to a mortgage? No, that's silly. I have to try and explain to them that's not, don't get used to this, guy. We're likely never to see this again. But for most other people, yeah, it's a bit more expensive, sure. But is it anything to worry about yet? I just really don't see that as being the case. Now, I like looking at Case-Shiller Index, Bob Shiller. They created an index a long time ago. And what it is, it's a repeat sales index. And I like it because it looks the sale, well, it looks at price changes based upon the sale of the same house over time. I.e., if you bought your home in 2020 or 2010 and sold in 2021, well, what's the spread between those two prices? So it doesn't look at the market in general, but it's a sale of the same house over time. And all markets, they cover 20 markets, are seeing pretty much everywhere very significant increase in price. DC's a bit lower. Even Chicago's 11.5%, which is extraordinary, seeing as that Chicago only just got pricing above the peak it saw before the housing bubble burst. But here in Seattle, and they consider Seattle the Tri-County area, King-Piston, which almost 23%. Below San Diego, more than LA and San Francisco, mainly because people are leaving California and moving elsewhere because it is so unaffordable, as well as taxes and the like. Vegas, remarkably good, and Phoenix is still going gangbusters. So if you look at the year-over-year change, but more importantly, look at the change from peak. From peak, Denver, I'm giving their forecast in a couple of days. It's doubled from the now this is the pre-housing bubble peak. So really a remarkable increase we've seen there. But prices have been appreciating across the board. So again, it's not a Seattle specific thing. We're seeing home price growth over the last 12 months, the last couple of years, very, very significantly. As far as our regional housing market is concerned, well, quarterly closings, you can see here, second quarter 2020, yes, we did see a drop. Why? Well, blame COVID. And in fact, when COVID-19 hit, I got more calls from reporters saying the housing market's going to go, it's going to burst. It's going to go in the tank. I'm like, no, it's not. Brokers are going to take 2 weeks off. Why? Because they had to. They had to because selling real estate for a couple of weeks was considered a non-essential industry. But look at the spike back we saw. We saw it here and we saw it nationally as well. Really very, very impressive. Demand is significant. And sales by year across the 3-county area, this is single family resale homes. We sell about a bit more than 37,000 homes per year. We've been blowing through that for the last 8-9 years, but particularly in 2021. So brokers across the board have been very, very busy. A lot of demand coming out, a lot of it COVID driven, but also a lot of it driven by mortgage rates and a lot of it driven by millennials, these young kids. And guess what? They're getting older. Across the country, 9.5 million will be turning 30 this year. That's the age they move away from hookups and into real relationships. And they think about getting married, having children, and wanting to buy a home. and 69% of them believe that buying a home will be the most astute financial investment they will ever make. Yes, they're still going to the bank of mom and dad. I know this, my eldest son, exactly what happened, but they are getting into home ownership. And that's driving a lot of sales now. They're having a problem, certainly in our more urbanized areas because of price, but they do want to buy. So we have a lot of demand and we still have not that much supply. And that's impacting prices. Tri-county area, I mean, the average sale price in December was almost 800, a bit more than 840,000. Median, I like looking at median, it just is a more accurate way of looking at it. But you can see with both these numbers that if you bought your home in 2012, your home value has quite likely tripled if you bought at that low in 2012. I'm not quite sure where else you can get that kind of return. Please don't say cryptocurrency, but it's really been a quite extraordinary thing. And very particularly, look at what happened through the course of last year. Yes, you see peaks and troughs, it's seasonality. You don't adjust prices for that, but a massive, massive increase we've seen. And we look at annualized changes, median up by almost 20%, over 22% on average. Again, the tri-county area. That is unsustainable. But it's done something for people maybe like yourself that own their homes that you rather like. And it's this. The share of homes with a mortgage in the three counties of homes that have more than 50% equity. King County has 50 or 59% equity. Snohomish 54 and Pierce 52. Insane. This, I mean, over half in all these markets, over half of homeowners with a mortgage have more than 50% equity. And that again does say to me, any worries about bubbles? No, not there. We are sat on a ton of cash. On the new construction side, we're not pulling enough permits. I mean, it's just not even close. What's been going on? We've run out of land, period. We are not going to be expanding our urban growth boundaries. I can guarantee you that it's going to be the case. There's too much water, too many mountains, and not enough land. Now, as a builder, you could buy, there's a lot on the market today in Bothell. You can buy a finished lot, ready to build. It'll cost you $700,000 for the lot. That means the home that you'll build on, you've got to sell that home for 2.1 million to make a margin. I like Bothell. I don't like $2.1 million Bothell. And that's a constraint because we know that land price has been escalating dramatically because there is no supply. We know labor costs increasing. No one's going to vocational school. I wish they were, but they're not. That pushes up labor costs, material prices. Lumber in America, the cost of lumber, or at least the increase in cost of lumber, has added $36,000 the cost of a new home across the country. But it's also steel, it's copper, it's aluminum, it's PVC pipe. So it's a lot more expensive to build, and therefore builders are being far more cautious because if they were to build, for it to make financial sense, they've got to be building to the upper end of the market. But unfortunately, that's not where the demand is. And so that's holding it back. Now, if we're not building more, again, go back to Econ 501. If we're not building more, that puts upward pressure on the existing inventory of houses in any market. But also something else. I mean, the Tri-County area, again, looking at permits, and the share of building permits for single-family homes has been on the decline since 2017. So we're looking at about, well, just shy of 36% of single-family permits were in the three-county area. The balance, which would be what, 64%, are elsewhere. That's a problem. And here's why. 52% of the population of Washington state is in the three-county area. 53% of the state households are in the tri-county area. So it's where we should be building far more, not far less. But those land constraints we have are very, very significant. But we're still going to have a lot of demand. That's about 960,000 houses, which are owner-occupied houses in the tri-county area. My 5-year forecast, 7.5%. What does that mean? We're going to have demand for more than 72,000 new owner-occupied housing units in the Tri-County area in the next 5 years. Well, if you remember the permit numbers, not even close. We need to address land use. Example I always give is here in the city of Seattle, 72% of the residential land in the entire city, North Gate to South Center, is zoned single family. That made sense back in 1938 when zoning was created here. It made sense through the 1960s. It makes no sense now. But the trouble is, and as Kari mentioned, I sit on the governor's board of economic advisors. I've been beating Governor Inslee up a lot on housing, on how we need to produce a lot more of it. And the only way we can do it is by changing zoning. Now, I think I've got a bit of traction now with him. He made an announcement recently saying that across the state that you can add density, you can build duplexes, triplexes, or 4-unit projects within proximity to any location that is a node of mass transit. That could be a light rail stop, or it could be a major bus center. It's a start, but it's not a panacea. It's not going to solve all the woes that we have here, because essentially we are built out, but it's a start. That was a theory which I shared with him, already been put in place in Minneapolis, Minnesota, in the state of Oregon, by the way. It kicks in inside the metro areas in May of this year. And down in California, Governor Newsom signed Senate bills 8, 9, and 10 a couple of weeks ago across the state that allows that kind of development. But where you are in areas that are, in essence, built out, the only way it works is to tear something down and rebuild. So let's say you buy 2 falling down homes and you build X number of townhomes or duplexes, whatever. But the trouble is, locally, given how much you have to pay for those homes, it still doesn't make sense. It's still not addressing that more affordable price point. So it's not a panacea, but we have got a significant, just not enough houses to meet what demand is going to be going forward. So you will hear a lot more, I believe, about zoning changes in our region as we go through this year and next. This is the activity. 348, I don't really trust the numbers because it's new construction. But if you look at sales, yes, we're modestly above the long-term average, but even then, new construction, about 6,500 units transact per year. We have been above that, but again, not coming close to meet demand. And on pricing now, average price last year was $900,000. That's for the year, not on the month. But I also look at price per square foot. What we've seen with that big jump, builders have been building smaller homes because it's more efficient for them price-wise and selling them. However, we've started to see builders now think about building bigger homes again. Why? Work from home. And that work from home paradigm, back in the day, Buchan, Bernstead, Chafee, all these guys always used to build studies, and they realized that no one used them. Well, guess what? Everyone's using them now. And so what people are looking for in a new home or an existing home has changed. They're looking for a dedicated workspace that's not their dining room table. And even home sellers, if they don't have an office per se, they're actually creating dedicated Zoom spaces, which I think is interesting because that's more important now for buyers than it has ever been. But new construction is trying to be more competitive. The premium you pay for a new home over a used on average is about 20%. Well, it's now down below 10%, but their share of sales did drop down to 13% last year because they weren't building enough because of the pricing situation. So we know existing homes, we haven't been moving as frequently, at least until COVID kicked in. We weren't building enough, which we've already talked about. So what's that done to housing affordability? Yeah, not good. Pierce County is technically unaffordable. That's the ability for a household making median income to afford a median priced home. Has been affordable here in King County since 2012. So that's a worry. It's a worry for me because, again, if we're going to talk about bringing companies in, driving that economic growth, you've got to look at housing cost. Not good. Now, that's for all buyers. What about first-time buyers? Well, again, horrendous. Not affordable across the board. And quite frankly, in King County, it's never been affordable technically for a first-time buyer. Now they have been buying, and we know people move across county lines to work and these kinds of things. But it is very, very hard for people to get their first foot on the rung of the ladder. Now, this analysis we've done at UW since 1994, it's scary. And so we need to be able to build more. Now, I talk about building more, and a lot of people beat me up left, right, and center. They think I want to build 50-story high rises everywhere. I don't. But we need to try and figure out a way that we can increase density, and it can be done very sympathetically, believe me, because these young kids out there, there's a lot of them. Yes, they want to buy. Yes, they want to be here, but they have become forced renters because they just can't afford to buy. Now, COVID-19 and work from home can potentially allow them to go further out to where it's cheaper. And I think that's what's going to happen. We'll talk more about that in a minute. But affordability is a significant issue. All right, let's run through the 3 counties quickly on what I think. Now, this is the first thing. It's what I moan and groan to the media about all the time. Now, it's this. This looks at active listings. In King County, single-family resale homes, 428. Now, if you are a broker, you say, well, actually, that number's not right. It is, but I adjust my numbers for seasonality. Otherwise, it kind of looks like my heartbeat, right, up and down. So when you adjust seasonality, it's 428. But in reality, is that the case? No. Real number, 2,179. Now, how can that be? Well, if a home comes on the market on the 5th and sells on the 15th, it's not counted under that active number. See, the active number that's reported by all the media every month because of the Northwest Multiple release, is a set day. It's the number of homes on the market, either, depending on which MLS system it is, either on the first day or the last day of the month. But it excludes new listings. So a normalized market, active listings should be above new. If the market's balanced, that's what it should look like. This is not balanced. When you see new listings significantly above active, it means homes are selling remarkably quickly. And we know that's what's happening here. And on the sales side, very, very robust. And I mean, annually, it's averaging King County more than 20,000 sales per year, going back to 2004. Well, we were knocking on 27,000 last year. So brokers have been remarkably busy. So it's not a case that there's nothing to buy. Yes, there are, but it's so competitive. Homes are trading a lot quicker, and it's not being caught in the headline numbers that the media talk about. Prices, sale prices of $1 million. Yes, we're off the all-time. Look at that price growth. I mean, 22% on average in 2021, and absolutely same number. Now you can say, well, what happened in 2019? Remember what I talked about mortgage rates? They hit 5% in 2018. That's what happened. So we saw a contraction there, but the price increases that we saw last year are at record highs, quite frankly, and they really are. And the markets which were impacted really very, very broad. But here's an interesting thing. Look at those increases. Redmond up by 43%, Bellevue 35%. This is the annual change in median price. Who was the lowest? Seattle, 7.5%. Even down in Kent, Federal Way. I mean, all these markets have been doing extremely well. And part of that is that work from home and people wanting to buy, starting to look into the ex-urban and suburban markets. And my forecast for some of these markets going forward is still, for this year, still pretty robust. I think we'll see an increase actually here in Seattle over what we saw last year. But really very, very solid price increases across the board, even on Mercer Island, which is not particularly expensive, sorry, cheap rather. So prices, again, I think we have another year where we'll still see double digits. But as the county as a whole, I like looking, given where mortgage rates are and some uncertainty out there, I put in my presumed, which is what I think it will be for the county as a whole, that everywhere, Enum, Claw included, is about 14%. It'll be a high about 15, low about 12.5. Yes, we'll come off that massive increase we saw last year, but it's still going to be well above the long-term average for King County, which is 5.5%. It's what it's been since 1990. So all things considered, we will see prices grow. It'll be a bit less robust, but mainly because of two reasons. One, some pressure on mortgage rates, but more importantly, affordability. On the multifamily side, the condo market, again, a similar deal. Nothing there, but really there is. So we saw a jump, as you can see here, the spike we saw here was basically driven by COVID. And mainly it was around multifamily homes in downtown Seattle. A lot of people chose to move away and they're like, I'm out. And therefore we saw a lot of supply come online, as you can see here. Now, when more supply comes online, what happens to list prices? They dropped. And what happened was fascinating. It's the fact that it's not a case that no one wanted to live in our urban markets. A lot of people do, but they couldn't afford it. But as prices came down, guess what? They could. So that demand got backfilled. So we still had significant demand going on. And we saw that drop in the second quarter when COVID-19 hit. The bounce back again was palpable as it was on an annualized basis. So multifamily hasn't gone away. I am bullish about the ex-urban and potentially some suburban multifamily markets. I just think they've got some legs. Again, that tends to be lower density, more 501, even 12-story products we see in some sub-markets, more so for the time being than in our downtown area. Why do we choose to live downtown? Proximity to work. Who needs that anymore? Also, bars, restaurants, social amenities. Well, chatting with Tom Douglas a while ago, yes, he's reopened 2 of the 19 restaurants he closed. Ethan Allen, he's opened up some more. But we need to start seeing that coming back before I think some people will feel comfortable. But again, it's also because of the safety, security, and the homeless issue, which is still hitting downtown. I walked down 4th Avenue last week. There are tents on 4th now. It's kind of on the scary side. So I do think, I'm hopeful that will get addressed. That demand will come back. We're not overbuilding on new construction, but it is, out of all the multifamily submarkets, the one which will probably lag a little bit more. And again, you saw that correction in sale prices because of COVID, and mainly because of the urban markets, but it has picked back up again fairly significantly. Pricing, again, has done okay, even through that. And again, mainly because of markets outside of Seattle. We've talked about King County as a whole. And overall, my forecast for this year, about 9%, could peak at 10. The low likely will be 8. Heading north now into Snohomish County, similar situation, nothing on the market. Guess what? There really is a lot of demand. A lot of people coming out, a lot of people moving out of King County into South Snohomish County. We're seeing a lot of gentrification occurring in Lake Forest Park, Mountain Lake Terrace, specifically. People are buying homes and doing some significant renovations on them because they're still close enough if they have to come into their offices. But again, it's a major discount from the prices you pay here in King County. Closings certainly dropped, but have bounced back, and significant increases there. But if on a sale price standpoint, still cheaper by a significant amount. I mean, look at the average sale price in December, 764, median 675, but more robust price growth we saw in 2021 than we saw in King County. Again, not surprising because it is still at a price discount, and a fairly significant one. The markets are increasing. You'd have thought it would be all to the south, right? No, even Stanwood, 22%, Arlington, 21%, Marysville is up there. So really across the board, doing remarkably well, even out to Lake Stevens, Granite Falls. I mean, every market has been performing well above any form of expectation in terms of price appreciation in 2021 over 2020. And as we look forward, I think we'll see probably 16% price growth this year. High will be 17.4, low 14.2. So it's going to come way down from that insane number we saw in 2021, but still be very robust. And a lot of that will be driven by people moving out of King County into Snohomish County. The multifamily side, it's not a big multifamily market, as you can see, but in reality, a bit better than the headline numbers show. Most of that demand is in that single family attached townhome product, far less than stacked flat. but it is starting to emerge as a bit more of a robust condo and multifamily area, mainly because of prices. And you can buy somewhere on average sale price was about 476 in December. Prices are from the multifamily side very significantly. So where people were thinking about moving out as renters, but still could not afford to buy single family, well, guess what? They were starting to look at those townhomes, at those duplexes. And just a couple of markets in terms of price growth, again, very impressive. Across what this is multifamily, it's a very small multifamily market still, so it's very bifurcated. It's located in certain niche markets, certainly not across the board. But price will be up by 16% this year. So it is still a very, very robust increase. And finally, looking down south into Pierce County, no supply. Guess what? Yes, supply. Now, here's what's interesting about that. Historically, if you couldn't afford, let's say you worked in King County, if you couldn't afford to buy a home here, what did you do? You jumped on I-5 and you booked north to Snohomish County. That changed 2 years ago, a bit more than that. And people started jumping on I-5 and going south into Pierce County. Why? Well, there's about $100,000 delta between prices in Snohomish and down in Pierce. Pierce County is becoming a bit more of a player. As you can see here, significant increase, roughly 10,000 units or so sell every year. And now 15,000, more than 15,000 sold. So a very significant increase. And because that you've seen those prices jump. Again, if you bought your home down there in 2012, well, tripled, a bit more than that. Pretty impressive. Everyone had been ignoring Pierce County for a long time. And I guess I would understand that, but it is a market now which has certainly changed significantly and a very significant increase in prices. And in the submarkets, I mean, everywhere. I mean, the lowest we found was what, Edgewood? Yeah, Edgewood. Other than that, 20% pretty much on average across the board. So it's not just in the most expensive market, which obviously is Gig Harbor and University Place, but really in all the balance of the markets as well down in Pierce County. Again, it really does scream to me one thing. People want to buy. If they can't afford here, they're going to buy somewhere else. And that has been driving some of these cheap markets. And that will be exacerbated ultimately by the work from home paradigm. And as we go forward, now it's probably 14% price growth. It could be as high as 15.6, but it's still going to be very, very robust. So when we think about the housing market, what do I think? Yeah, we should be building more. We're not. That therefore does put upward price pressure on existing stock. But yeah, we have to slow. We know it will be slowing because of affordability and because of modestly increasing mortgage rates. Now, I ran a couple of numbers and said, okay, let's look at the median sale price, quite frankly, anywhere in 2021 at what the average mortgage rate was then. And then let's say what the payment would be based upon today's rate. Well, the increase is $300. So it's not that substantial. So when you see rates going up, and they have jumped by 0.5 point, but when you're jumping from 3 to 3.5, it's a lot different from jumping from 6 to 6.5. So that tells me that we will still see people out there that could drive some more demand to come earlier, potentially some buyers getting off the fence because they expect, as I do, rates to rise. They don't want to lose out. But although we have been moving more frequently, I would caution one thing, and don't think about the world today. Imagine your world in 2025. Why do I say that? Well, you're sat in your home quite comfortable with a whole ton of equity at a 2 5/8 mortgage. And mortgage rates in 2025 are 6.5%. Are you going to sell? Or are you going to renovate and stay put and not lose that never to be seen again historic mortgage rate? This could be yet another longer term problem, systemic problem, because we just won't move, because we don't want to lose this rate, which we are likely to never see again. But the move to the burbs absolutely is real. Work from home. A lot of businesses expected they'd make those announcements and those policies back on Labor Day of last year. They didn't because of Delta. The Delta variant of COVID-19. Then they said, okay, the end of the year. Then that didn't work out because of Omicron. When they do, And some have. And anecdotally, I'll tell you that Amazon, who basically said it's down to the managers to make those decisions. But rumors that I've heard are, yeah, you can work from home, but you have to live within 1 hour of the office. So not a case, we're not going to disappear off to Boise. Not going to happen. So it will be that 1 foot in, 1 foot out. But when we do get more clarity, and when workers get more clarity on exactly what is the plan for their companies, then you could find certainly some existing renters say, now's my time, or even some existing homeowners. So we could find more demand coming online. Now, if you're an existing homeowner, that will help because that's going to add potentially to supply. But we could see some greater turnover. But a lot of companies, again, have not yet made those decisions because of the variants of COVID-19. Yeah, more removed. I still see significant demand in Pierce, in Kitsap, in Snohomish, but yeah, we're not all booking to Yakima, guys. It's not going to happen. It just won't. But the areas that surround our business centers, I think will do particularly well as we go through the course of this year. So in closing, what do I think? Rates will rise. Affordability scares me, and it really does. Housing bubble, no, we are remarkably overqualified to buy homes, not underqualified. For levels of forbearance, and forbearance, by the way, is it's a program which worked remarkably well, meaning that you could not pay your mortgage because you were laid off or furloughed. But ultimately, when you come out of forbearance, you have to make the bank good by either refinancing or extending the term of your loan. I mean, right now we're down, I don't have any more recent numbers in September, but in King County, we're down around 1.5%. So it's de minimis. And there's no way we're going to see a flood of foreclosures. Now, some of our brokers at Windermere have been asking me, like, Matthew, I've got buyers that are saying they're going to wait because they're waiting for forbearance to end. They're going to see a flood of foreclosures, flood the market, pick up a house on the cheap. Good luck. Not going to happen. If for no other reason that the buildup of equity people have seen. If somebody bought their home in 2019, they're sitting on an average of more than $100,000 of equity today. They're not going to let that go. As tight as the market is, what they will do, if perchance they can't get themselves back on the straight and narrow again, they'll sell. It's a great housing market. Yes, we will see foreclosures rise, but back to historic averages and likely not until 2023. So that's nothing to worry about. We're very overqualified to buy our homes, more down payments. So no bubble, but affordability is an issue. I do expect to see the ex-urban and suburban markets do remarkably well, but I'm not discounting King County at all. The numbers clearly show, numbers don't lie, it's why I love economics, that there is still demand, but that pace of price growth certainly has to slow. Brokers have had a remarkable year, or had a remarkable year in 2021. I think the transactional velocities will be up in 2022, not by a huge amount, but up modestly. Prices, again, will rise, but at somewhat more modest pace of growth, but it's still going to be double digits this year. And in all, it's still a remarkable market. And quite frankly, the last thing I would say is that why are people coming here? Well, a lot of people coming here from California. California lost population last year. And sorry, Siri's talking to me. So what's happening is that they lost population. Why? Well, people leaving the state because of housing prices and because of taxes. Where have they been coming? Heading up I-5, the 5 as they call it. They've been coming into, a few stay in Oregon, not many, a lot keep on coming north into our area, and they think we're cheap. But they're not just coming here. They're going to Boise, they're going to Salt Lake City, they're going to Austin, Texas. Now you might wonder, hang on, why are Californians, generally speaking, a remarkably blue state, going to Utah or Texas? Well, Austin and Salt Lake City are dots of blue in a sea of red. Very, very liberal. In fact, my middle son just moved from San Jose to Austin 2 months ago. So those are markets which I think are doing well for the out-migration from California. But a lot are coming here and they still think our houses are cheap. They want to be here. I mentioned property prices down there, extortionate, also taxes, but also climate. Climate change is something, by the way, over the next several years and going forward, is going to become more important for home buyers than it ever has been before. specifically millennials, even more so. Believe it or not, Gen Y and Gen Z, they're not ready to buy yet, but they do want to know that their home's not going to be underwater. And as we see that climate change is not going away, what does that mean? Well, it means that people are coming further and further and further north. So that is certainly going to be a benefit to our market. However, it's still not going to help with affordability. All right, with that, I'm going to hand it back to Kari. And hopefully, if you've got one or two questions, I will be delighted to answer them.
Thank you so much, Matthew. I thought that was super informative and definitely speaks to what I've been seeing in the market as well.
Oh, good.
I think we do have a couple of questions. Alex, do you have any questions there? Well, I have a question.
Shoot.
You know, we were talking a lot about Snohomish and Pierce and King County, but really, what do you think about Thurston County? Because don't you see people moving towards Lacey, Olympia, Tumwater, because it's between Portland and Seattle, and I'm kind of envisioning people moving that way.
You can. Now, Thurston County market tends to be very oriented around government. Government employment is massive, obviously because of Olympia.
Mm-hmm.
It's trying to get some urban vitality going on. They're building some multifamily stuff, which is kind of cool to see. Not a big area. And the issue with government employees is that they've got a job, they just don't make any money. And that's been an issue. But what we are seeing more than anything else is a move in the industrial market. Historically, the Kent Valley was 250 million square foot market, industrial space. It's moving further south. It's gone past Pierce County. It's now looking at Thurston. It's looking at Lewis County for warehouse distribution space. That drives certainly a lot of jobs, but again, most of the jobs tend to be not homeowners. They tend to be renters. So I think that Thurston, yes, to a degree, but it will still be subordinated by, I think, by Pierce County. So in the same way, looking north, I think Snohomish County would do well. Skagit County, however, just too far away. If you have to come downtown, and quite frankly, Skagit County housing market kind of really doesn't do very much. It never has. I'm sorry if you live in Mount Vernon, it just doesn't.
I have a house coming on in Mount Vernon, so we'll just see, Matthew.
Oh no, I'm sure it's going to be fine. But in terms of the work from home paradigm, because it's going to be split, it's too far away for a lot of people to consider even driving down a couple of days a week into King County. So, but Kitsap County is another one which I didn't touch on. That it's got the land out there. We know X out Bainbridge Island, but Poulsbo, Silverdale done remarkably well. I think, believe it, that Bremerton got a massive contract from the federal government to the Navy down there. They did bring on the passenger-only ferry. The trouble is the damn thing breaks down every day. If they can fix that, then I think Bremerton's another market which could actually do better than most would have anticipated. So Kitsap County is another area which I think is one which we need to be keeping. I'll be keeping more close tabs on than I had been historically.
Yeah, Port Orchard seems pretty close.
Yeah, Port Orchard is gorgeous. Yeah, as is Portsmouth actually.
So does anybody have any other questions?
Well, we have a ton of great questions coming in.
Oh, shoot. All right, bring it on.
Let's start with Tina Mitchell asked, sorry, I have a little thing.
Tina, ask your question.
Oh, sure. Go, Tina.
Hey, Tina.
Yeah. Hi, Matthew. I was just thank you so much for the information. Always a huge value. We didn't talk about what your 5-year forecast might be for King County. And I see someone else asked the same thing in Seattle.
Oh, really? Yeah, I mean, it's so funny that the crystal ball fogs over pretty hard when we start looking at that length of time. Now, I've got decent demographic forecasts, although I'm still waiting on, I mean, I've got the OFM numbers for population, but census numbers, I'm not going to get census numbers until August. Okay. Anyway, I think that 5-year, I expect the trend on price growth to continue to taper back down closer, I would argue, to that long-term average, which would be about 5.5% for King County, about 4.5% historically, 4.5% for Pierce, and about 5% for Snohomish. But it's quite likely that Snohomish and Pierce, if we are really in a different world today, well, we know we are, but if that different world is going to continue, if we don't believe, and I don't think we will, I don't think we're ever going to go back to 2019. I think we have seen a paradigm shift. I mean, I'm sat in my office admittedly at night, but for the last year, it's been me and one other person in 36,000 square feet. So it's only because I hate working from home. So those changes are there. And I don't think for a lot of people, it really is going to go back to what we remember. And if that is the case, then that will be to the benefit of those surrounding markets because of the discount on price. So I would say that within the next 5 years, price in King County will likely drop back, revert to the mean or so, depending on where mortgage rates go. But I think we will still likely outperform in Pearson up in Snohomish County. But the big thing is really going to be land. I mean, Governor has already told me I've got to go down and spend some time in Olympia through this legislative session and the next, and basically beat up a whole bunch of senators on how are we going to address the issue over housing. And it's an issue which people are very much one side of the fence or the other. I mean, not your show. I'm on another radio show in Cairo every month, and following one I did a couple of months ago, another I think you call yourself DJ, whatever, Dory Monson. So he wanted me on, and he screamed at me like, "You want to build all this stuff everywhere?" He thinks again, I want to build these 50-story high-rise. No, I don't. But here's the issue: people don't want change in their own environment. They say, "Well, I love what I've got. I don't want this to change." But it can be beneficial, believe it or not. Brings in more people, actually brings in more economic vitality. There's all kinds of reasons why it's a good thing, not a negative thing. But we need to get more of the NIMBYs, not in my backyard, into the YIMBYs. Yes, in my backyard. Because without that, again, we're not going to grow our growth boundaries, and our zoning is beyond antiquated. And that is a big, big issue. Because we've lived on we've lived on the backs of giants since 1917, when Boeing was created, just about 3 blocks away from where I'm sat right now. Where they went, we went until the early 1970s with the big Boeing bust. Well, then the 80s came along, and a couple of guys messing around with computers in a podunk office in Albuquerque became what? Microsoft. And but we've done so well, not because we are Seattle, but because they all went to school together, more by luck than judgment. That's going to change. And as it changes, if we want to attract businesses, yes, we're smart. I mentioned that earlier. But housing and the cost of housing can become prohibitive. You can say, well, yeah, but it works down the Bay Area. Well, yeah, because you're forced renters. Bottom line is affordability, on average, about 6% of homes that sell are affordable to somebody making median income. The least affordable housing market in America in the third quarter of 2021 was Corvallis, Oregon. Yeah,
Wow.
I know. Blame Oregon State University, maybe. Anyway, but it is that affordability question. So, long-winded answer to a direct question. We need to build more. We just have to do that. If not, then it's likely we'll find companies just looking elsewhere. Part of the reason why we're seeing that expansion by Amazon on the east side. They believe housing supply on the east side is greater than Seattle. And it's true. So long forecast said revert to the mean in King County, but it will be above that in Pearson, Snohomish, and it could be a little bit more than above that in Kitsap County. So I think those surrounding markets, likely, if we keep on going down the road we are, will still outperform, less so here in King County.
Yeah,
But I
well,
certainly
thank
don't
you,
expect to see
Matthew.
prices
It's
dropping.
good news to hear that it's in the 5-year forecast. Most likely we'll get into a balanced market because, as you know, a balanced market is what benefits our economy, which benefits all of us. Even the homeowners were better off in a balanced market and not having that.
Oh, sure.
Dramatic
Absolutely,
situation.
absolutely right.
Thank you, Matthew.
Oh, you're welcome, Tina.
So we've got lots more questions. So
Keep going. I'm in no hurry. It's all good. I will stay as long as you say it's okay to stay.
Tim Kraus, do you want to ask your question?
Yeah. Hi, Kari.
Hey.
Yeah, thanks. Thanks very much for that presentation. I thought it was.
Oh, you're welcome, Tim. I hope you enjoyed it.
I did. It was very, very good. I was just wondering if you could give your thoughts on the downtown Seattle market. And some of the key drivers, let's say over the next 5 years, because it seems like it's hit a tough patch, but is that going to turn around, or are they going to continue to be mired in the problems?
So I try to stay away from politics, because if I say something, that means that's Windermere's position. But I will say this, and I'm pretty sure that the Woods aren't going to become too mad at me. When we moved to districting a few years ago, as I'm sure you know, and in theory, districting made sense, because the view would be you'll have an elected council member that will be taking care of your needs. Well, the trouble is, when we did that, it allowed some people to get into office and in essence take a controlling position, as opposed to, which means that you're really kind of stuck with them because you can't get rid of them unless you live in that district. Mm-hmm. We tried it a while ago and that didn't work, as opposed to it being at large officials. So, I mean, I can go back clearly remembering having screaming matches with Nick Licata in City Hall. And I love Nick, he's a great guy, but I thought he was that far away from flying the hammer and sickle over the council chambers. But once the cameras got turned off, then he wanted to talk behind closed doors and he would actually listen. Unfortunately, certain council members who I have met with, I walk out the meetings because I just can't, it just doesn't make any sense. There's some ideas that are being thrown out there which I don't understand as an economist, that are coming from somebody else that also professes to have a PhD in economics as I do. Not quite sure where they got it from, but we cannot give away everything. It doesn't make any sense, because what's going to happen ultimately is this. I know I'm kind of talking in circles here, but at some point, if we don't address the issues that are there, and they are humanitarian issues, they are revolving around homelessness, they are revolving around drug addiction, all these things which are heinous situations, and they really are. We do need to figure it out, but we can't just give the world away, which is kind of what happens, because what's going to occur is that all of a sudden we're going to find the share of retail sales taxes that the city gets is going to start dropping. We know they're working on a budget deficit for the next biennium anyway. Potentially, we could see their share of property taxes dropping, certainly on the commercial side. And so they're kind of almost biting off their noses to spite their face, because by taking this, by looking at the city in isolation, to say, well, we want to change things, but we're going to do it just the city of Seattle. No, things need to be addressed on a regional, not citywide level. And the reason being is that if you do it just in the city of Seattle, that allows people to go somewhere else,
right,
across the bridge.
Right.
It's not rocket science. So, I miss Conlon, Compton, MacGyver, even Nick Licata. I do miss my conversations, my discussions with them. Unlike our current cadre of officials that are going down a path which I just don't think they understand the responsibility they have, but the consequences also of their actions. So we've got to be very thoughtful about this. And the trouble is, by going to a districting scenario, I can't say I think this person's silly, I want to vote him out, but I don't live on Capitol Hill, so I can't. So now, bottom line is, never count out downtown Seattle. And you really shouldn't. We've had some amazing years. We've had some horrendous years, but it does tend to bounce back. And I think that it will likely take some time. And certainly one of the biggest issues today would be, well, let's say Weyerhaeuser. So Weyerhaeuser moved out of Federal Way, right? They moved into, Greg Smith built them a building in Pioneer Square. And they already said to their staff, we're not going to allow you to go into the office until we perceive it to be safe.
Yes, amazing.
That's a pretty major indictment, in my opinion. And if people aren't going there, I mean, downtown Seattle works during the day when there's 280,000 people downtown, which is on average what there should be during the workday. We're not even close to that. Right. And that hurts naturally those bars, those restaurants, and the mom and pop, the bricks and mortar retail. And I would say, by the way, to all of you, where you consider it safe to do, please don't spend your money with Amazon. I mean, Bezos can survive that divorce. It's okay. Go and spend it locally, because it is our our ground floor retailers sort of spent money, bought that stock, that they're trying to cover that debt, and they are hurting more than anyone else. And they are they're a core to our community. So we need to really kind of try and respect them and protect them. But they are leaving because of the fact that the police are hamstrung. They won't arrest anyone for shoplifting and blah, blah, blah. So yes, it is a tough situation downtown. I mean, there's the new, what's that new restaurant opened that used to be something 74, RX 74. It's now Bourbon Steak on 4th Avenue. Wonderful new restaurant opened up. I walked past there, and now directly across the street, there's just a row of tents on 3rd Avenue between Union and Pike. I mean, that's a no walk zone right now, as far as I can see. So there are issues, but I talk a lot with John Scholes, head of the Downtown Seattle Association, and he agrees with me. I don't discount it. I think, however, there are obstacles to to our urban environment, but don't discount it. We will come back, and I have no doubt, but it's just going to take a bit longer. But the one positive thing is we didn't overbuild. I mean, in Manhattan, last few years, they built, what, 40,000 new condos.
Right.
We've got like 3, maybe 4 urban projects. So we didn't do that. That's a positive thing. For comparison purposes, back in 2005, I gave a speech and there were 32 new construction condo projects in Belltown alone. So it's a very different environment. So we're not overbuilding, but we really, I think City Council, and it's really, I'm looking to the mayor and Bruce. Bruce is a friend of mine, and I supported him to personally to try and get some kind of middle road, because that's what's going to be important.
Yeah.
It will come back, but it will take a bit of time.
Oh, very helpful. That's all very helpful. Thank you very much.
You're welcome. Next.
So Kelly, do you want to ask your question, or we can read it out for you?
Hi, thanks,
Hey,
Matthew.
Kelly.
That was really awesome. Thanks so much. Very interesting. I was just curious what, I know you spoke a lot about affordability. I'm just curious what the definition might be, or various definitions of affordability.
Okay, so on the affordability index, what we use is the ability for a household making median income to afford a median priced house. Very straightforward calculation. But what we're also missing on top of that, which I didn't talk about, is middle housing. And what's middle housing? A lot of people ask me about this because they hear it, that term used all over the place. Now those are households making between 80 and 120% of median income. And those are going to be the nurses, the firefighters in our area. And it's remarkably, remarkably hard for them. But by definition, affordability is the ability for a household making median income to afford a median priced house. Does that make sense? Kelly?
Yeah, sorry, I was trying to unmute. Yeah, so what is the median income in Seattle?
I'm not sure that they do it down as myopically as Seattle. I know they do it for King County.
King County.
I'd have to go into. Okay, I will be talking. You know what? How about can I get back to that in a couple of minutes, because I'll let you know what it is. I'm going to jump on the OFM website and find out what it is.
Thanks.
You're welcome.
Well, we've got a couple more questions. Do you want to go ahead with your question, Big?
Yeah, I was interested in how some of the colloquial,
Big is very big.
Okay.
I was wondering about some of the colloquial, nicknames for different areas. You had mentioned Mercer Island's very affordable, but it's
not affordable. It's the least affordable. Go on.
It's also been known as like Poverty Rock, as one of the old nicknames for it, because you had a toll bridge there and back. You have Briar, that used to be known as the cul-de-sac speed traps, or Malt Lake Terraces, the dog patch.
Yeah.
And so I was kind of wondering how some of these old nicknames, Everett, catching up or affecting prices as you run some of the simulations and some of the different cities. Does that affected at all?
Wow. I mean, you brought some names which I had never heard of, but there again, I'm not from around here, born and raised in Yakima. So
I'm
Back
from
of
Easter
Vegas,
Island.
represent.
Easter Island and Poverty Rock, I always thought was a joke.
well, I mean, so Mercer Island, yes, an island, yes, it's unconscionably expensive, but there again, so Medina, so's Yarra Bay, so's Hunts Point. So it's not just on the island. I think that what we are experiencing in some respects are markets that historically people kind of backed away from hugely because I would never want to live there. Now, I will give you a good example. Now, West Seattle is a market doing okay, even with the bridge, but woe betide anyone that took one step south of Delridge Way. However, I believe that White Center will probably see some of the greatest price growth this year of any market in that area. We really are seeing some of those markets which had been overlooked. Now people are saying, "Yep, I think that I can make that work." Same thing applies to Central District in Seattle, which is anywhere from Madison to Dearborn. So there are these niche areas which people have been erring away from that are now saying, if it's approximately where I need to be, then they're willing to take that risk. I'd not heard of the things, again, I'm not being a local that you've mentioned, but I do see markets emerging, which is very classic, actually. I can look at back east when I was teaching back at Harvard way back when. And even around New York, past New Jersey, people are like, New Jersey, you're not going to live there. But now there are homes there in the $3 to $5 million price point. So it has changed significantly, as it has in Manhattan, the Upper East Side also became hip, and then Lower West Side did, all these kind of things. So you do see some areas that historically had been overlooked start to become of greater interest to would-be home buyers. And in essence, what happens when that occurs is that gentrification starts happening, then the retail starts happening, economic vitality starts happening, and an incoming tide raises all ships. I'm not sure if that answers your question or even close to it. But what I guess I'm trying to say is that it doesn't surprise me to see some of these more unique markets that had been overlooked start to come into focus more so now. Now, whether it be the Mercer Island rock, got a median home price above $2 million. Yeah, it's a rock, but it's an expensive rock.
So that also kind of leads into going back to what you're talking about in the legislative session coming up, and talking with those, and also development and redistricting of land. One of the things I've kind of followed loosely is the Hearst decision. And I know that they've made some changes on that. And I was wondering how that is going to affect what it is that you're going to talk about in Olympia in this upcoming session.
Not that much, quite frankly. I mean, you think about Hearst, Hearst was to protect water resources. So when you look at more urbanized areas, it tends to be far smaller an issue than areas elsewhere. And it's part of the reason why when I go and meet with senators in Olympia, I mean, I can't keep the senator from Ferry County, for example, engaged. He's like, well, we've got 100 years worth of land out ahead of us. Who cares? But when we look at it in the central Puget Sound area, her city is far less consequential than it is as you move further out.
So we only have a few minutes left.
Oh, good Lord, really? Sorry.
Two more questions that I really want to let people ask. So Janice Cohen.
One thing, whoever was asking me about Seattle, by the way, on income. So the median household income in Seattle in 2020 was $95,089.
$95,000 median income.
That's the median. That's the median household income. Yeah, average is $136,300.
Oh wow! Thank you.
You're welcome.
So, Janice.
Thank you, Judith. You like economics. the dismal science for a reason.
First, I want to thank you so much for this excellent presentation.
You're very, very welcome. Thank you.
Thank you. My question was, do you think that office buildings will be converted to housing?
No. No, well, okay. I say no in a very arbitrary way. If you're thinking about our concrete and steel high rises, the answer absolutely is no. And there's very specific reasons why. Core depth is one, plumbing penetration is another. And I say core depth, what does that mean? It means if you were to convert them, you're going to get a whole bunch of very narrow units. And anytime you move more than 20 feet, 24 feet away from natural light, it doesn't work. So I do not see, for example, Columbia Tower converting into residential uses. So no, as far as our bigger buildings are concerned, it just doesn't make sense given the way they are built. Now, some of our smaller office spaces, maybe, but I would suggest we are likely to see other asset classes convert before office. Now, what would those be? Strip malls. We're not overdeveloped, we're under demolished. Strip malls are horribly overparked. They make no sense. No one wants to go to them anymore. Thank you, Lake Forest Park. It doesn't work. So we're seeing that is certainly something which is definitely low-hanging fruit. Also, inns, not big number. I'm not talking about Marriott hotels, smaller inns, and the innkeepers are having a heck of a time just keeping their nose above water. We've seen a lot of foreclosures in that asset class already. That wouldn't surprise me because, again, it's far easier to convert that kind of product into residential. But in terms of our urban offices, no. And there's another reason as well. And the presumption that the work from home paradigm is going to mean no one's going to be working downtown. Not really quite the case. Yes, they will occasionally. However, what you need to look at is the square footage per employee. Back in 1990, gross square footage per employee was about 250. It's how all analysts calculated demand for office space. Over time, that whittled its way down to probably about 145 square feet. Why? Well, I mean, there's no server floors anymore. Technology has done its thing. Law firms don't have law libraries, maybe Kennel Gates and maybe one other, but in general, that goes away. So that's scaled down. But as we go forward, as people come back into the office, not as many, but they're going to require more space, not less. So what was 145 square feet could increase. So the fact is the footprint can actually stay the same. Oh, by the way, at Amazon, it's not 135 square feet, it's 90 square feet per employee. So, I mean, they shoehorn people in there. They can do that because you can choose when you come into work for the better part. So I don't see our urban office buildings converting, but maybe some low-rise office. But again, I'd be surprised at that happening. But I would argue that there are other asset classes that will convert first. Strip malls, ultimately regional malls. And I've said this for years, as Kari may remember. 3 years ago, I said within the next decade, we're going to lose half of our regional malls in America. And I stand by that statement today. Now look what's going on in Northgate. So that is, which by the way, is the first ever regional mall in America. That's now we're seeing conversions there. So I'd say you're going to see malls convert. You'll see strip malls convert. You'll see inns convert, smaller hotels before there's any thought on conversion of office buildings into residential uses.
Okay, thank you.
You're welcome. Last question.
Alex, do you have a last question that you wanted to ask?
Yes, we had one question that was asked twice, so I figured we definitely should check that one out. It was, any thoughts on the Alki area specifically, or West Seattle?
Right, so West Seattle, a great question. So when the issue with the West Seattle bridge happened, I had all manner of reporters calling me saying, okay, well, it's going to decimate that market. Well, probably not. Has it? No, it hasn't. So I think that area, certainly depending on where you are on Alki, anything that's waterfront, it's got a view, it's not, there's still going to be demand. We're not creating any more waterfront housing. So we are, but in general, there's still significant demand there. And ultimately, the bridge will get fixed. We know that's going to happen. I think within the next year, it's going to be reopened again, I believe, if not sooner. So that will be okay. Now, therefore, it's been expensive. So what we've actually found is that from a demand standpoint, a lot more people started looking at Burien than West Seattle. Why? You can actually get downtown from Burien quicker than you can from West Seattle. And that's even when the bridge was working. So that was a market which really went gangbusters for a couple of years. But anything on the Alki Beach area certainly has done very well. So we're not going to, those views aren't going to go away. The bridge will get fixed, no doubt about that. And because of the potential for work from home, we could see an increase potentially in the ferry across to downtown. But the trouble is, it's like any other thing. When you build a node of mass transit, that's great if you can walk there, but if you have to drive there, if you can't park, then you don't do it. And so you can say you're going to increase the number of passenger ferries coming across, but if you can't park anywhere to get there, that kind of defeats the object. But the Alki market is a delightful area. A lot of friends of mine live there. I think it's going to be just fine. And a lot of people that had hoped the prices were going to plummet because of the bridge, well, as you can see from the numbers that I showed you, they didn't get that one right. It didn't happen. And you say maybe COVID was beneficial because of it on a time standpoint, but I think the West Seattle market is going to perform just fine. But you are going to find the affordability issue is going to push people, as I mentioned earlier, further down, other side of Del Ridge, and they're going to start heading that way because it's just becoming increasingly unaffordable. Admiral Junction, again, doing its thing, a lot of apartments going up there. West Seattle is kind of a cool little hub, I think. And because of that, it's got a nice little node there. I think it's going to be just fine.
So Vitali has one last question about supply chain. Do you want to ask that, Vitali? Or who?
I think that was Michael's question up at the top. He did step away, but I can ask for him. We were talking about, sorry, with current strikes and issues in the supply chain, do you anticipate home builders will actually start building again? How else has this stall affected the growth of our local economy?
Oh, wow. As far as builders go, I am hopeful that we will see some easing in the supply chain issues we have through the course of this year. And if that happens, that should hopefully ease some of the price pressures that they're facing. Now, that said, lumber, we've still got a tax on imported lumber, softwood lumber from Canada. What did the Canadians ever do bad to us? But it's still in place. So we're doing that. But it's a longer term issue as well. They had a lot of beetle issues back in the day. Then, of course, Warehouse that has 2 million acres between Oregon and Washington had issues with forest fires. So there are supply shortages. The biggest component of the push on lumber pricing actually has been us. We've been through pandemic. We've sat at home saying, I'm going to build a deck. So we've been heading off to Lowe's and Home Depot and picking up this stuff left, right, and center. And that actually has been increasing the price of lumber significantly. Home remodeling was $36 billion last quarter. It was a massive amount of money. So we've been doing that, and which obviously hurts the production builder. So there are still, now, will that tariff come off? I can't speak for the federal government. It'd be nice if it did, but there's still issues there. Copper, aluminum, steel, we still have tariffs with China. Whether they're likely to go away anytime soon, probably not, given Xi Jinping's position in terms of the Ukraine. So don't see that helping. PVC pipe, by the way, has also gone by. If you want to know the price changes on PVC pipe, all you got to do is one thing. When you fill up your car with gas, look how much it cost you. Next time you fill it up, if it costs you more, then PVC pipe prices have gone up. pipe prices they track oil prices perfectly. So they've been escalating, as we all know, given the price of fuel. Now, as we go through the year, yes, there is an expectation. And in fact, my forecast for new construction activity in America, single family sales, it's probably going to hit about 982,000 this year. That's going to be up from 780,000 in 2021. So we will see increase, and it's based upon the fact that I do expect to see some easing in the supply chain concerns. That means that those raw material prices and availability should start easing somewhat. And I'm hopeful that if that's the case, builders will build more, and that will certainly help. That's part of the reason that's going to offset some of the demand for housing, because it's going to go to new rather than resale. And also new home builders are being far more competitive to the existing market than they ever have been. And they can also build what people want. People want those studies. Now we wanted the open plan concept forever. Now we want room separation because of the vid. So they're changing, and they're also changing where they're building. They're looking further out into some of those ex-urban and suburban markets where land is cheaper, again, because of work from home. So I was on some conference calls with Toll, Pulte Homes, and one other over the last month. And they are pretty bullish for this year in terms of their expectation that material costs should start softening. And now I know they're publicly traded and they say whatever to boost their share price, but a lot of what they said did tend to make sense to me. So I wouldn't be surprised to see some easing in the cost of materials, but we do need to get rid of some of these tariffs that were implemented by the previous administration. They're still in place today.
So on that note, thank you so much, Matthew.
You are welcome so much. Thank you, all of you.
So informative, and I'm sure that we could go on and on because this is really riveting, and there's just so much to talk about in the economy right now. So if anybody has any additional questions, please email me because I can get those to Matthew.
Oh, sure.
And get that answered. And I'm so thankful that you all came and shared this time with us. Be sure to put next year's forecast on your calendar now. We're going to be doing it on January 12th. So right at the beginning of the year. And that's hopefully going to be in my office in Bellevue, but
it better be.
If not, we'll be here again. Either way, it's going to be a fun time. And, you know, before you all leave, I want you to know how grateful I am that you know, you could all be here, and I hope you all stay healthy and safe and happy. And if you need me or my staff for any reason, please let us know. I care about all of you, and I really appreciate you coming. So thanks so much, Matthew, for joining us.
Oh, you're welcome. I will say one thing, by the way, you'll be getting, Kari will be getting a copy of the presentation, a PDF of it. My assistant will send it tomorrow morning. Feel free to peruse it at your leisure. Great bedtime reading, fall asleep in a heartbeat. But you'll have that tomorrow, so you can go through those slides at your leisure. And as Kari said, if you've got any questions at all, reach out to Kari. I'm here to support our brokers. So anytime that they or their clients have a question, if I don't know the answer, I know a whole bunch of people who will probably be able to take care of it. So yeah, let her know. She'll tell me, and I will get you that answer.
Sounds good. This will also be available on YouTube, so you can send it to your friends if you want to share with them. So thanks so much for everybody for coming. And I hope you enjoyed your fun and refreshments package. And I look forward to seeing you guys all, hopefully at my Seafair party. So
stay safe. Spend money in the local stores, please.
Yes, local stores.
All right, guys, take care. Be
Bye,
safe, everyone.
Thank you.
Thanks, Matthew.
You're welcome. Take care.
Hi, Zelly.